Good morning, good afternoon, good evening, wherever you may be. This is Sid Norris from ElliottWavePlus.com. And this is my 1 hour presentation for the Synergy Traders number 53 Fibonacci and Elliott Wave Trading Strategies event. So I'll be on here for an hour, and I've made a little outline of what I will be covering today. But before we get started, I'd like for you to be aware of my disclaimer. It's at my website, ElliottWavePlus.com. So to read the disclaimer, please go there and scroll to the bottom of any page at the site and click on this Terms of Service Disclaimer tab. So there it is. Please go there and read it in full. If I were to summarize that in one sentence, it would be there's risk of loss in all trading. By the way, as long as I'm at my website, I'd like to point you to some resources there that are free. So you can go to the resources tab and you can see educational videos, educational guides. Those are actually just written documents, PDFs. And you can go to my blog. Additionally, um, I have a YouTube channel, and it is called Elliott Wave Plus. And I will occasionally put up videos of my presentations for different events, or if I'm seeing something particularly important happening in the markets, I might put up a video there. So you can subscribe there. And you can also subscribe to receive my emails at my site. There should be a pop-up that comes up where you can subscribe and receive emails announcing different events um, or blog posts, et cetera, et cetera. So there is on my website. Please go there and check that out. I'm really glad this morning, by the way, that I followed Aldo Lugretta. I think he did a fabulous job of giving an introduction to Elliott Wave. And this is something that is critical and to understanding Elliott Wave is to start at the beginning and go through and learn the basics. Something I always recommend, and this is the book that Alda was talking about, Elliott Wave Principle by Frost and Prechter. The first 100 pages of that book, if you're highly interested in Elliott Wave, I'd recommend going through the first 100 pages of that book maybe 3 times in a row. Just read it through, take notes, um, and um, and that really gives a solid outline to the wave principle. There are plenty of other educational materials available. Like here's a video I did, a beginner's guide to wave counting, Sid's Elliott Wave 101, how to navigate around my website, introduction to how I combined Elliott Wave and Hurst cycle analysis. I'll be talking about that today. Why use the wave principle and lots of other educational materials. Also in the resources, if you look under guides at my site, you'll see a big document that talks about the special notations that I make on charts and how to interpret those and what they mean. Also, when I was first studying the wave principle, and reading the book, not only this book, but lots of other books. I have every book that Robert Prechter ever wrote, and I have every document ever written by R.N. Elliott, and have made really a lifetime study of it. And I have created an outline of sort of a Cliff's Notes, if you will, of the Elliott Wave principle. And it's at my site for free. And you can go through there and it talks about all the guidelines and um, rules, as well as talks about some Fibonacci targets that you could use. And I've actually, ever since I wrote that document many years ago. I have established some additional Fibonacci target um, techniques that I'd like to show you today. So what I'm going to go through for you today is I'm going to show you how to use your Fibonacci tools to establish targets. And for today, I'm going to use the example of the Dow Jones Industrial Average, a very long-term 100-year chart. And by the way, I think I'll go ahead and turn the video off of myself so it won't be a distraction. I may turn it back on after a little bit. Um, So we'll be looking at a 100-year chart of the Dow Jones Industrial Average. We'll be counting the waves, and we'll be using Fibonacci tools and indicators to try to establish what the correct wave count is going back 100 years. And then once we finish with that, I'll discuss what is likely to happen next on the stock market. And then I'm going to also show you charts where we can draw some Fibonacci tools, use some Fibonacci tools to draw targets and establish a long-term wave count on gold, bonds, and the US dollar. And then I'm going to show how I weave Hurst cycle analysis and one additional form of technical analysis or cycle analysis into my wave counts and also sentiment. So this is what you just saw before I came on was an excellent introduction to Elliott wave. I think you would, what you'll find out is that I have been doing this for a long time and I'm um, more into a very advanced application of Elliott wave. And so if you have questions along the way, please put them in. I'll try to keep my eye on the chat. Some of this is going to be new to you. A lot of it probably will be. But anyway, just keep me posted on if I'm losing you or not. um, or losing your attention because of how I'm adding so many different tools in to try to establish what is the correct wave count. So, and then finally at the end, I have an offer. If you've never subscribed to my service, any of my levels of service during 2024, send me an email, sid@lawaveplus.com, and let me know you'd like a 50% refund off your first month and put at any of the 4 tiers of service that I have there. Also, I've got quite a few screenshots that I have prepared for today's presentation. If you'd like to receive a download link where you can view and download the screenshots from today's presentation, send me an email. And I'll be happy to get you a link so you can see that. So we're going to move now to my trading platform or my charting platform, and it's called Trade Navigator by Genesis. It's been around for many decades. And we're going to look at this long-term count on the Dow Jones Industrial Average. I'm going to turn the video myself back on just for a second and show you that I'm going to use a page that I scanned out of this book, At the Crest of the Tidal Wave by Robert Prechter. That book was published in 1995. And here's what Prechter did when he wrote that book all those years back. Is he has tried to go back in history and establish what a much longer wave count than what is possible with the Dow Jones Industrial Average, because the Dow Jones Industrial Average began in the year, actually, I need to change that. It's 1896. 1896 is when the Dow Jones Industrial Average began. And the first major event that occurred after the beginning of the Dow Jones Industrial Average was, of course, the crash, the 90% crash in the stock market that occurred between 1929 and 1932. obviously a huge and important event in history. And so, if you look at what he did, that is right shown right here in this chart. So he went back into Europe and all the way back to the year 1700 and tried to establish how the wave structures might have looked like, and kind of took that European data and pasted it back um, prior to the Dow Jones Industrial Average to get a longer term um, Elliott wave chart. And so this was published in 1995. And it shows that the South Sea bubble right here. And then in the middle of the 1800s, the what was happening during pretty much during the Civil War, leading up to the Civil War. Civil War ended in I believe it was 1865, so pretty close to here. And then we had the run up to a super cycle wave three peak that is shown on my chart at the 1929 high. Now, some people look at this a movement right here and think, well, that really doesn't look like an impulse. Well, yeah, it kind of does. One, two, and admittedly, this wave three was choppy, but one, two, three, four, five. So there's that three and four in 1920 and 1921. So we'll set that aside here for a second and we'll start looking at these wave counts the way I am showing it on this chart. So this is using Prechter's work. And if you are aware of Robert Prechter, you're probably aware that that book, which was written in 1995, was suggesting, or published in 1995, that that book was suggesting that we were nearing the end of a large degree fifth wave, a super cycle, wave five, and the Dow at the time was only at about 4,000. And I'm going to show you why he thought that. And he had some very good reasons to think that was exactly what was going on at the time. And so starting at the super cycle wave four low in 1932, we have a one, two, three, four, five waves up for wave one, then an A, B, C for wave two. So once again, I'm glad that we just saw an introduction to the wave principle. As you'll see that um, what was just shown by Mr. Lugretta will use in this demonstration over and over again. And so that would be a cycle degree one and cycle degree two. So cycle degree three, which ended in 1966. This is still Robert Prechter's count from 1995, um, subdivided as a 1, 2, 1, 2, 3, 4, 3, 4, 5. So um, that is a five-wave structure. Something that you might need to know when counting waves is when you have 1, 2, 3, 4, 5, 6, 7, 8, 9 waves. That basically is an impulse. And in the stock market, it usually subdivides as a 1, 2, 3, 4, 5. And within the third wave, you get five waves: 1, 2, 3, 4, 5. Well, it's very obvious that that third wave in burgundy was longer than one and longer than wave five. So it was the longest of one, three, and five, and that is follows the rules of Elliott wave. And that completed a wave one in cycle degree, two at cycle degree, three at cycle degree, and then it was time for wave four. Well, as you just learned from the previous presenter, wave fours can be any number of Elliott wave structures. They could be a zigzag, they could be a flat, they could be a triangle, or they could be a complex double zigzag, triple zigzag, and several other things. But in this case, wave four was, in fact, a triangle, and it was a rare triangle structure. It was a what we call an expanding triangle, A, B, C, D, E. So it was a megaphone pattern. And that is a triangle that ended in 1974. And then we embarked on and have been in a fifth wave up in the U.S. stock market ever since 1974. It's still not over yet. Now, Prenter thought it would end about here, 1995, and I'm going to show you why he thought that. And so these are four really important Fibonacci, um, I would call them guidelines to how to establish Fibonacci targets um, in a five-wave structure. So typically, wave threes. So this let's look at these teal-colored waves. One, two, three. Typically, wave threes will be at least 1.618 times the length of wave one. So we're going to grab a Fibonacci tool over here, and we're going to start here, and we're going to figure that that's wave one, and this is wave two. Oh, and there's something else really important that I need to tell you, and that is that I am using a Similog chart, and my Fibonacci drawing tools are using Similog math. You cannot, so only certain charting platforms allow for you to set your candles or set your chart to Similog. And just so you'll know, I'm going to take it out of Similog mode. And this is what this chart would look like if you took it out of Similog mode. So Similog mode basically kind of figures things along the way in percentages. And so I'm going to turn it back to Similog and notice that have this checked, use Similog for the drawing tools. This is critical. And if you try to do this on Thinkorswim, for instance, it won't do it because they don't have Similog mode and they don't have Similog drawing tools. However, if you use TradingView, it does. It will allow you to do this. Now, whether or not you can get a data set for the Dow Jones Industrial Average going back over 100 years for TradingView, I'm not sure. Would also be a requirement. But those are very important things to know about the tools and the charts that I'm using here. So notice from if this is wave one and this is wave two, wave three at this line right here would have been 1.618 times the net traveled, or it would have been of wave one. So you basically take this as a unit of one, take that times 1.618 and add that product to this bottom here, and you get this target. Well, you can see that it came very close to that, but it didn't quite reach it. It came very close to it, but it didn't quite reach it. So this would be a slightly shorter than normal wave three. Well, if you get into some of the more advanced topics on Elliott wave, if the wave three was a little shorter than 1.618, then you are very likely to get an extended fifth wave. And that's exactly what we're getting. Also, if the wave four is a triangle, the fifth wave will be what we call a terminal thrust from a triangle. In other words, it's likely to be a five-wave structure, but it's likely to be aggressive, very aggressive. So we call those thrusts out of triangles. So triangles are a narrowing sideways consolidation usually. This one is actually expanding. And those are usually followed by a very aggressive move to the upside. So those two things explain why this, at least partially, why the move up from 1974, the five-wave move up, is still underway. The rule is, and Steve, and it's a good question. Three needs to be the longest is actually that's not the correct terminology for wave three. So here's the exact rule. Wave three cannot be the shortest of one, three, or five. That's the exact RN Elliott rule. Okay. So you're welcome. And so we have a one, two, three, and four, and the wave three was nearly 1.618 times the length of wave one, but not quite. And that suggested that we were going to get an extended fifth wave. So what do we normally look for in a fifth wave? Well, this brings up the next, what I believe are the most typical targets for the end of fifth waves, and that is where wave five of an impulse will be equal to the net traveled of 1 through 3 times 0.618. And that target was right there at 4,134. So I'm going to bring you back to Prechter's chart, and you can see he was looking for the end of a normal fifth wave up from the 1932 low. So 1, 2, 3, 4, 5, at about 4,000. There was a reason why he was doing that, at least the way I look at things, and that is there was a typical target for the end of a fifth wave right about there in around 1995. However, the market kept going up. As a matter of fact, it found a new aggressive upside gear at that point. So when you have a move that where the fifth wave extends beyond that normal target, what you're very likely getting is an extended fifth wave. Okay, so in an impulse, a five-wave impulse, this is getting a little bit more into some subtleties instead of the basics, some more advanced topics on LA wave. In an extended fifth wave, there's several different targets you can look for. Well, the first target you can look for is where the fifth wave up would be equal to the net traveled of 1 through 3. This also explains why Prechter was wanting to call a major top in 2000 or 2007. This is really a rather magnificent fifth wave up and very, very highly extended. And so the normal tools that we have to use um, kind of have to be thrown out. We have to find some different Fibonacci tools to explain why this thing's so extended. So the next one I'm going to show you is very important, and that is where the fifth wave up, where basically, let's say the market topped right now, right now. Um, so what we would do in these very long-term charts is we would try to establish a relation, some sort of Fibonacci or golden section 0.618 or 1.618 relationship to either through to 1 through 3 or from the beginning of the pattern through the bottom of wave 4. So I'm going to use a Fibonacci expansion tool. And basically what this tool, what I just drew is basically considers the price action from the 1932 low through the 1974 low, a unit of 1, takes that times 1.618 and looks for that level as an extended target above the wave 4 low. So in essence, what this target is at 41,020 is where the entire five-wave up structure from the 1932 low can be cut by the golden section at the 1974 low. So notice that that target has been hit very recently. And so how why would I want to give weight that to that target? Well, I all by itself, maybe I'm not that interested in giving a tremendous amount of weight to it, but I want to find some other potential Fibonacci targets that would corroborate that target. In other words, it would suggest that we would get a major top somewhere very close to that price. And so for that, we're going to look at the price action up from the 1974 low. So we already had a triangle here. This is a thrust from from an expanding triangle, and it should subdivide into 5 waves up. One, two, three, obvious. It's obvious that that's the third wave, the fourth wave, and then the fifth wave up from the 1974 low. So remember, each odd numbered wave, this one, two, three, four, five, that's for wave one, and then the wave three, one, two, three, four, five, and then the fifth wave up from the 1974 low also needs to subdivide into 5 waves. One, two, three, four, five. So let's see if we can find some Fibonacci targets based on what we see here so far. Well, the first one is um, this wave three was massive. And I'm talking about in Burgundy. That would be the move up from the early 80s up through the year 2000. Um, so we'll look at drawing a Fibonacci expansion off of this wave one. This is another thing you can do. Whoops, that's the wrong Fibonacci tool. We'll use the expansion tool. And many times, wave one, if you look at the length of wave one, you consider that a unit of one and take that times either 1.618, 2.618, or 4.236. You can expect that to be a target. And in this case, we had a huge expanded or extended third wave. So I'm going to delete some of these. And notice that that wave three in Burgundy was basically a 4.236. Yes, that's a Fibonacci number. 4.236 expansion of wave one. That would be a Fibonacci target for an extremely extended third wave. Okay. And then once you have the third wave and the fourth wave, that we're looking for the fifth wave, but let's look at one other thing here. So wave fours typically retrace wave threes by 0.236 to 0.382. So now we're going to look at a retrace of the entirety of wave three. And we're going to see that the wave four retraced very close to 0.236 retrace. Now, typically you would look for a 0.382 retrace on a wave four, but after that extended of a third wave, a massively extended third wave, you'd look for something a little more shallow, and the next Fibonacci retrace target for wave four is the 0.236. 0.236. And you can see that that price almost came down to that. So now we're looking for how about for the end of Burgundy wave five? So Burgundy one, two, three, four, five. By the way, here's your key down here. Burgundy is primary degree. So for that, we're going to go back to a typical wave five target. And we look for wave five to be In this case, normal. Why would we look for a normal fifth wave here? And the reason is because usually, and this is another subtlety in Elliott wave, usually in the stock market, one of the odd numbered waves in an impulse is extended. And it's quite obvious that we already got an extended third wave. And in the case of the stock market, it almost always, but not always, but almost always is the third wave that is extended. And so I've measured the distance from the start of the pattern through wave three. So that's the net traveled of one through three. And then look for the wave five in Burgundy to be 0.618 times the net traveled of one through three. And that's measuring up from the wave four low. And you can see that that target, that's that little thin line right there, is almost exactly with that first target that I showed you. And then finally, and we're going to move into some shorter term charts in a minute. We're going to look at these targets a little closer up, so they're a little, so we get a better look at them. But I'm going to show you one additional target here, and that is within this fifth wave up, that should subdivide as a five wave structure as well. But we're expecting it to be normal. In other words, the top around in here. And so 1, 2, 1, 2, 3, 4, 3, 4, 5. So we're gonna do the same tool. We're gonna go up through wave three and wave four. And now we're going to look for the fifth wave in black, and that's at intermediate degree, to be normal. Now, can anyone tell me why would I expect the fifth wave to be normal here and not extended? So I gave a clue earlier but why on black one, black two, black three, and black four would I look for a normal black wave five here? Anyone? Yes, exactly. Thank you. Investment advice. The wave three in black was already extended. So we've already seen an extended wave within waves one, three, or five. And so we'd look for this to be normal. And notice, I'm going to go back real quick. I'm going to show you, I already counted these subdivisions here and then the corrective. And then within this wave three, one, two, three, four, five. And then within this structure up here, this wave three up here, we had one, two, three, four, five. And you can even see five waves within this move up, this black wave three. Matter of fact, I can add these in here. So one, two, three, four, five for the third wave. The fourth wave, that was the Black Monday crash back in 87. And then one in blue, two, three, four, five. I mean, all the subdivisions are pretty clear. They really are. Now, a lot of people, a lot of other Ellioticians that have services are subscribers of mine. They follow my work. And I got to tell you, it's tough for someone that's running a service to be calling for a major top like this because it's bad for business. And so what you'll find is you'll find some Elliott wave counters trying to change this wave count into something that is more bullish, like calling for 1, 2, 1, 2, 3, 4, 3, 4, 5, or on up. But I think that based on the eyeball test, every subdivision is in place and proper, except for we don't have a completed five wave up structure from the 2020 low yet. So there's that cluster of three Fibonacci's together on this quarterly chart. This is the normal quarterly chart that I normally send. By the way, there's my email, Sid at Elliott Wave Plus again. First time subscribers get a 50% refund off their first month. Email me ahead of time to get the deal. So, um, up from the 2009 low, 1, 2, 1, 2, 3, 4, 3, another triangle, another expanding triangle, but at one lesser degree than actually two lesser degrees than this expanding triangle that lasted from 1966 to 1974, and the upward movement from the 2020 low is a thrust from a triangle. So let's look at the monthly chart. There's those three tight Fibonacci targets that I showed you. And this exemplifies how we have moved into the bottom portion of that Fibonacci target zone. Matter of fact, we've almost reached that middle target for the end of black or burgundy wave five. That'd be the best target for the fifth wave up from the March of 2009 low. And the upper target up there is a bit higher. So let's move on into the weekly. So once again, as a reminder on this monthly chart, I'm expecting this move up from the 2020 low to be a five-wave structure into that target zone and to complete a large degree grand supercycle wave three top. And then we would get probably the largest and longest lasting correction that we've had, well, in a very long time. This correction here that lasted from January of 2000 to March of 2009. So that was a little more than 9 years. And by the way, the next K wave low, Kondratiev was a cycles guy that going way back 100 years, I think. And this 1932 low was probably a K wave low. K wave is a 50-year wave. And then the 1982 low was probably a K wave low. So the next K wave low would be doing about 2032. So as we move in a little closer, this move up needs to carve out a five-wave structure. Well, so far, it looks like what we've gotten is a 1 and a 2 and maybe a 3 forming its top forming now, but we still need a 4 and a 5. Still need a 4 and a 5. It's not a completed five-wave structure. I don't see a way to count it that way. And so it needs five waves in order to finish off this deal, and I just don't think it's complete yet. Now, I've got it as an ending contracting diagonal. So the prior teacher, Mr. Lugretta, had talked about how sometimes a five-wave structure is overlapping and narrowing, kind of like a narrowing wedge. And I think that's probably what we're getting here, and here's why. This initial move to the upside was very likely an ABC zigzag. So ending diagonals are odd because each leg of the diagonal is not a 5, it's a 3. It's an ABC. And yet it continues to trend gradually higher. And so the fact that the wave C, so I've got this as a 1, 2, 3, 4, 5 for A, and then a B, and then 1, 2, 3, 4, 5. The fact that the wave C was almost exactly equal to wave A indicated that this was in fact a zigzag and very likely wave 1 of a final five-wave overlapping diagonal that would end somewhere in this target zone up here. So that it's been a little rough to try to figure out where the end of the wave 3 is up here, and I'll just show you that I do some additional work besides just counting Elliott waves, and there's some very important reasons why I do this. I incorporate Hurst cycle analysis into my work, as well as the cycle tool that's at the foundation for the study of cycles. And I use those to kind of confirm about where the next turns are going to be in the market based on something that isn't Elliott wave. It's cycle analysis. It's completely different methodology. And so I marry the two together when I establish these wave counts. Um, Hurst is Hurst. Hurst. Was a American engineer that had access to mainframe technology through his work back in the 1970s, and he developed something called Hurst cycle analysis. Um, HU, I'm going to type it HURST. Google Hurst cycle analysis, and you'll probably find a program that called Sentient Trader, and it's one that I use extensively. And I'm going to go into that now very quickly, and I'm running a little long on time. There was a couple of things I wanted to show now that we're getting into the weekly time frame. So one is back in 1995 when Prechter wrote his book. And I already showed you that there was a potential for the end of a five-wave up structure from the 1932 low at that time, but something kicked in about that same time frame, and that was money printing. And you can see that the money printing has gone through the roof. And it's at least one explanation of why we're getting this massively extended fifth wave up from the 1974 low in the stock market. Notice that the money printing certainly was moving aggressively already certainly from that 1995 low. The exponentially increasing money printing. And in March of 2020, there was 2.1 trillion of stimulus printed. And then in March of 2021, an additional 1.9 trillion. The money printing became obscenely large, so far larger. It dwarfs the money printing that Bernanke did toward the end of 2008 and on from there, the systematic money printing. And that printing uh, ended that expansion of money supply in about 2021. The printing party was made possible by low inflation. And I think the Fed, the Congress, and politicians, presidents, they all felt like, as long as I guess we can just go ahead and just keep printing because um, we're not seeing runaway inflation. And we didn't. Here's notice this is the inflation percentage as printed by the U.S. government. And notice that inflation peaked in 1990 at 5.4%, and very shortly after, that gray zone right there was a recession. And you can see it peaked right here in about 2000, and shortly thereafter, we saw a recession. It peaked right here in 2008. I'm talking about inflation percentage. And very shortly thereafter, we saw the worst recession we've seen in quite a long time. And then we got a short recession associated with COVID, and they basically printed like never before, and inflation shot up, at least on this weekly chart, to 8%. On a monthly basis, I believe in July 2022, it reached up to around 11%. So this was the first time that they printed so much that we got this inflationary blast. And at least this chart back through the end of 2023 was only down through 4.1%. With the Fed's target, it's 2%. But imagine, if you will, you turned on a burner on a stove and you started reaching over into the burner and putting your hand above it. And each time you did it, you'd hold your hand there just a little longer. a little longer each time, and it never burned you. But guess what? They held their hand over the fire too much this time, and they got burnt hard. And we got this blast of inflation, and that is why they had to quit printing, and they could no longer. Really, as long as inflation is above the Fed's target, they really can't print away recessions anymore at this juncture. So, another thing that has triggered recently is something called the song rule. The song rule. So, what I'm presenting to you right now is why we might see a recession imminently and why that could mark this important peak in the stock market. So we've already shown how we've got a Fibonacci zone that we are reaching into for a significant peak. And I'm showing you what other potential evidence we have that where we might be reaching an important peak in the markets. This is a kind of a chart that explains the Psalm rule. You may have read about that some in the media. That when you have a bottom of a low ebb on the unemployment rate, and then it starts to tick up. Each of the last three, four recessions, and really every recession going back in history, other than one time, one slight exception. You would once you started seeing the unemployment rate tick up, that was followed by a recession. Same thing right here. The employment rate started ticking up, and then we got a recession. That was in the 2001, 2002 timeframe. The unemployment rate started ticking up back here in 2007, really even possibly late 2006. And that was followed by a massive recession. The unemployment rate kind of double bottomed here at 3.5% going into the COVID crash. And we got a short recession that they printed their way out of. And during that recession, unemployment reached 14.8% very quickly. But now we have this situation where in January of 2023, unemployment rate bottomed at 3.4%, and it's starting to tick up. And it has ticked up enough that based on this pattern, a recession is very likely imminent. Here's another chart that I show my subscribers that shows why recession might be imminent. This is the 10-year bond yield versus the 2-year bond yield. Typically, and normally, the 10-year bond yield will ride a bit higher than the 2-year bond yield, and it did. It usually does. And the reason is if I'm just going to loan money to the government for 10 years, I'd want a little bit higher guaranteed return than just loaning it to them for 2 years because I'm taking on more duration risk. And starting in July of 2022, those two inverted, and we started having what would be considered an abnormal bond market, where the shorter duration bonds were actually paying a higher rate of return than the longer duration bond. And that inversion continued until this month. September 6th, they finally uninverted. So this indicator down here is the spread between the 10-year and the 2-year. So typically, after a period of inverted bond yields, a recession will typically begin about when they uninvert. So, in my opinion, and all of this talk on propaganda financial TV about a soft landing is a fairy tale. But this particular um, in period of inverted yields or abnormal bond yields lasted the second longest in history. The only one that lasted longer was the one that led to the 90% crash in the stock market from 1929 through 1932. So as you can see, I look at a number of different things to try to not only technicals but some fundamentals. And here's another thing that I use. This is called Hurst cycle analysis. This we are basically right about here in price right now. And Hurst cycle analysis figures out about 12 different cycles that are running constantly in the markets, gives equal weight to each one, and provides a composite line moving into the future about what the likely cyclic direction of the markets will be next. And this composite line, the orange line, it's suggesting we get a peak toward the end of this year, specifically November. And then we moved down through March of 2026 up through November 2027 and then on down. And notice that these lows over here are getting pretty close to that 2032 uh, K wave or Kondrativ 50-year Kondrativ cycle wave low. So here's a closer look at that. So we've zoomed in a little bit. Now, right here in June of 2025, there's a large cycle nest due there. But notice that the composite line is suggesting this market is going to find a way to stay up through November of 2024. But notice the obvious left shoulder, head, and right shoulder pattern that potentially could develop over the next few years. But no, this also suggests that, and by the way, the orange line, it suggests direction, not price, direction. This could be a much deeper move to the downside or it could be more shallow, but it does suggest down from November of 2024 to uh, March of 2026 next. Moving in a bit closer, this is really zooming in. It's suggesting that the market is going to quote unquote stay up until late October. Well, that's really close to the election. And this is something I've been putting in my videos, and you can go back and look at those at my YouTube channel or at my blog. And that Hearst has been suggesting, Hearst cycle analysis, that we're going to stay up through about the election, but then the reaction in the stock market after that is going to be quite negative. Now, I'm not saying it's because of the election or that the market is being held up intentionally until the election. I'm not suggesting any of that, but I'm just saying that the date of the potential peak seems to be continuing, and it has for months to suggest that the market will stay up until approximately the election, and then it's bearish. And look at this: one, two, three, triangle for four, five, down into April of next year is what's being uh, suggested down through about April of next year. So Hurst cycle analysis is one tool that I use. I also use the cycle tool at the foundation for the study of cycles. I call it the FSC cycle tool. And there is a very large cycle. It's a 181 week cycle that has been running in the market for a very, very long time. As a matter of fact, one of the authors I've read, besides all of them, are in Elliott and Proctor, is Dewey, Edward R. Dewey, and he was a huge and very important pioneer in cycle analysis and going back about 100 years. And he found this same 180-week cycle as being the dominant cycle in the market, in the stock market, U.S. stock market, going back that far. And it still to this day remains uh, dominant cycle. And what that cycle length is from bottom to bottom is about a 3.5 year cycle, 3.5 year cycle. And it is suggesting also that the market will stay up through late in the year, and that cycle peaks around December 16. here in a couple of months, and then is bearish through uh, late September of 2026. So once again, we get back to this, and it's very, very similar, and yet these two cyclic tools use completely different methodologies. The Hurst cycle tool fits price action into a model that he predicted, whereas the FSC cycle tool simply looks for which cycle has been the strongest and the most mathematically evenly repeatable in going back in history. And there's a graphic representation of that 181 week cycle. And you can see it is obvious that that is the dominant cycle in the marketplace. So there's more evidence that the next thing we're going to get is potentially a bear market, um, that and possibly a multi-year bear market. Okay, so very quickly, I want to show you a couple other things that I um, use at my site to predict important swings. So this is a weekly sentiment conditions chart on the S&P. So this is indicates how commercials are currently positioned versus how retail traders are currently positioned. And as you can see, commercials have not been very enamored with this last move up in the marketplace since October 2023. They have mostly remained hedged. So what commercials are is in the case of the stock market would be large banks, investment banks, and possibly central banks, and whereas retail traders obviously would be small traders, and they have generally recently been very bullish, whereas the commercials have been on the bearish side. Also, another indicator that I show is the money flow versus RSI. And when the RSI gets in its overbought territory, the money flow is above it. That is suggesting that that is not going to be the peak. But when the RSI is in its overbought territory on a weekly chart, and that means above 70, and the money flow is riding below it, we get one of these dark red zones, just like we got back here in late 2021. It's the last one we got. And that really is a warning um, of an impending peak of some time, of some kind. You know, I was going to show you gold, and I'll just show you I've got 2 more minutes, and I'm going to show you a few Fibonacci targets on gold as well. And we're going to run out of time. I'm not going to be able to show you the bonds or the U.S. dollar, but on gold up from the 1999 low. One, two, three, four. So everything up since December 2015 is very likely a fifth wave up in gold. And we've got a one and a two and a three and a four in place. So we're in the fifth wave up, wave 5 of 5 on gold. And it is subdividing as a one, two, and then one, two, three, four, five for three. Probably need a bit of a dip for a 4 and a 5 yet. And there's a couple of Fibonacci targets up here. One is where wave 5 black would be normal, but a lot of times fifth waves aren't normal in gold. And so that one has already been uh, beat. And so we're probably looking at an extended fifth wave up in gold. So the best black wave 5 target, 32.34. 3660 would be the best burgundy target. So there's the target zone on gold. I do think Bitcoin is going to rally in the fifth wave up until approximately February of next year. I'm sorry I can't show you that chart. Be sure to go to my site. I'm giving half price off your first month there. Subscribe to something. And I think I'm about out of time. And so,